Welcome back. You're watching The Money Show on ET Now. Well, we just had a very interesting discussion with Prableen on the often seen disparity between what the equity markets are doing and what some of our own mutual funds in our portfolio are doing. When should you essentially decide that, okay, this mutual fund is a persistent underperformer, and when should you just act with a little bit of patience? Well, let's move away from mutual funds and talk about the IPO market. Take a look at some of the recent IPOs, and there have been quite a few of them, especially in the last 2 to 3 odd months. The most recent one, of course, is Burger King. We've been seeing what sort of a rally we've, look at the kind of rally we've seen in Burger King. The way, firstly on subscription, on listing day as well, and it continues today too. Further, look at the way we have also seen other stocks like a Rossari Biotech, a Happiest Minds move. This is something that's really attracting all of our attention. Chemcon, Mazagaon Dock, all of these have also been overly subscribed by investors. More than 100 times than what was offered by these companies has been lapped up on subscription by investors. So it raises 2 points. Firstly, every IPO is not going to perform the way some of these stocks have. So how should you assess whether an IPO is good enough to invest in? And the second point that it raises is, with these IPOs getting over subscriptions of more than 100x, as we have seen with Burger King, Chemcon, Mazagaon Dock, Happiest Minds, how can you ensure allotment for yourself? I have with me Harsh Jain, co-founder and COO of Groww. Harsh, many thanks for joining us today on ET Now. To start with, Harsh, we don't have much background information on an IPO. So what are the factors that you look at when, deciding that an IPO is worth subscribing to or not?
Yeah, we've seen IPOs going really popular in the country lately. See, a part of it is to do with the demand also. Like, people have a lot of cash and, in general, capital markets are becoming attractive, and IPO is a way for people to enter into it in a different way because it's at a fixed price and you know what the value of the company can be. So there's not like a specific advice like whether to put in IPO or not, because it depends on individual IPOs. One needs to really look at the company and the fundamentals, which they should do anywhere. Investing in stock market, they should know about the company, and if they strongly believe why the company or the industry will do good, that's why they should enter the business. But from an IPO perspective, there are a few things where retail investors can look at. One is you can see what is the purpose of the company to raise funds, like what is the use of it, how are they going to invest it to make more money. The fresh capital that is going to come should generate higher returns than an investor would expect otherwise. So that is one way to look at it, understanding that part. And of course, the management's experience based on whether they have been part of the listed companies and to manage those extra additional work that is required once the company goes public. It's going for the first time. And thirdly, there's some more information that, there's always a 3-4 days window when IPOs are allowed. And then for the first 2 days, retail investors can track what is the level of subscription, what's the multiplier that has already happened, like we saw for Burger King, right? It was oversubscribed by almost 68% for the retail investors per se. So that also gives a feel of how the IPO is going to open it. Because after the IPO is live, the company is live, then anyway, people can invest in the company if they want. But just per se IPO, I think that these are the few things that they can look for in addition.
Okay, Harsh, now, if we look at some of the subscription numbers, Bector Foods is currently on, but it's already been subscribed 6 times. This is as per day 2. What you see on your screens is as per day 1. 6 times, that's already more. But look at the the IPO for a Burger King. Look at the IPO for Happiest Minds, Mazagaon Dock. More than 150 times. This again begets the question that if I even put in my small bid, to get the shares of these stocks, will I even be able to, get the final allotment? Because there are only a certain number of shares that the company wants to sell, but there are so many investors pouncing on some of these shares. So, Harsh, what would be your recommendation on how investors can sort of increase their chances of getting an allotment?
Like IPO, we've been seeing a great popularity, for the IPOs. While so on Groww, we see retail investors just subscribing first time in their life. So they've not done KYC before, they've not invested before. They just start their investing journey through IPOs, and that's the kind of popularity because the companies also popularize a lot. Now, increasing the probability of getting a lot when it's oversubscribed. So I think one thing, what is a popular practice is to apply from a lot of your family members, because in the retail, the it's a lottery system, right? It will be done on each pen basis. If all the application individual holders have got one lot, then the second round will come. So there is no point in less significance in applying for more bids if it's already oversubscribed. So what helps in increasing the probability is one, people keep getting apply from different family members and the knowns and things like that. That increases. And from a caution point of view, I think the bid that you put is usually should not be below the cutoff in case of these popular IPOs, because that will just disqualify the application itself.
How tricky is it to invest in an IPO according to you? Because like I mentioned, there's lack of information. Do you think that it would be a bit more risky to invest in an IPO, to subscribe to an IPO, than you would do normally for a secondary market stock?
So two parts to it. One, yeah, definitely there's less information available in the public market from the company. I mean, IPO compared to a listed companies for some time, but there's a lot of information which is disclosed in the process itself. So even the financials and what the business company is into business, about the management, all this information is available for the public even before subscribing to the IPO. There is always a risk because you don't know what price it will open at, and when you are in the second market, you can see the price transparently. But there are some signals, right? You can see in the first couple of days what is the level of subscription, what is the level of interest coming from the QIBs or coming from the HNIs or the mutual funds, and you figure out what direction it's going on, and you can apply for it. And the risk is not as much because the lot size and everything is defined, and your quantum is kind of fixed in this sense.
And Harish, finally, what would be the red flags that would preclude you from, subscribing to an IPO?
So see, practically every company that goes for an IPO will have a very legitimate use of the funds that they are going to use it for. But sometimes it will be on the growth of the business. Sometimes it could be to given liquidity to the existing investors. And then the second part to understand from this is actually how's been the operations. So that the claim of the use of the money is going to be the same as what it will be eventually over time. So, and that comes from, again, understanding deeper into the business and the business model, how the industry is scaling, and that kind of capital when comes, will it give an advantage to the company to grow further, or will it just be a filling in for the losses or the kind of liquidity crunch that the company has? If the company has too much debt and then they're raising funds to repay that, that's a different use case versus they want to expand into new geographies and they want to launch new product ranges. So that way, it's a more of a subjective call. But I think the use of the capital also gives a lot more information about whether the company, I mean, not just IPO success, because IPO success comes, one part is obviously the popularity, another part is obviously the company's fundamental. But overall, being invested in the company, there's a lot more value if you can learn and understand these fundamental business models of the company.
Okay, Harsh, many thanks for joining us today then on ET Now, and sharing your views on the entire IPO market and the practicalities as well of it with our viewers. And on that note, we'll take a very short break on the show. Don't go anywhere.